Welcome to Between the Lines, the podcast that dives deep into the stories reshaping Asia Pacific's reinsurance landscape. We're coming to you from the newsroom of InsuranceAsia News here in Hong Kong. I'm Andrew Mullen, Deputy Editor. As always, we're here to unpack the biggest stories and give you a preview of what's coming up from our editorial team. But before we get into the news, we've got a great conversation lined up here this week. Our guest is former Steadfast COO Nigel Fitzgerald. He recently launched a new MGA in Australia. Nigel sat down with Mithun Varkey to talk about the story behind Kaibridge, a new tech-driven MGA in Australia. The discussion touches on gaps the company aims to fill, how it plans to overcome tech debt and operational complexity that still hold many legacy players back with its digital-first and AI-native business approach.
If you think about it, the cost to serve is cheaper, the capital management capability we have through profit optimization is greater. So even if we launch in a soft market and our turnaround times are within an hour, then how could a broker not show us the submission through worry that another broker will if they don't? So even if we're in a huge information gathering phase for the first year or two, working out how we use our improved business model to differentiate and when do we start to intentionally be more competitive than the market, then that's still a win.
Joining me in the newsroom today is the FUD editorial team. I've already mentioned Editor-in-Chief Mithun Varkey, Senior Correspondent Aidan Gregory, and reporters Joana, Nguyen and Roshan. Welcome, everyone.
Hi, Andrew. Thanks for hosting the show.
Pleasure. Yeah, we've definitely broken from our usual bi-weekly publishing schedule this week to record an episode on April 1st. Now, that's not April Fool's, but instead it's the day the reinsurance renewals take place in Japan, India, South Korea, and the Philippines. The team has been speaking to the market and have been scouring the reports, and will bring you a country-by-country breakdown of this key date. First, though, even though it's only been a week since our last episode, there has been several stories making the news. Korean broking group Simon Global has received approval from the Hong Kong Insurance Authority to launch an MGA. SXG Underwriting has been approved to become a Lloyd's cover holder, and this is the first by a Korean broker. Speaking of Lloyd's, they have received regulatory approval to establish a branch office in Gift City in India, that's India's special economic zone. And American private equity firm JC Flowers has announced that it has entered into an agreement to acquire a controlling stake in Nguyen Group, while also acting as a lead investor in the newly established Lloyd's syndicate, Nguyen Syndicate 2047.
That's quite an interesting development from India on Nguyen Group. I mean, we've seen quite a lot of new reinsurers come into the Gift City sort of offshore special economic zone, but I think Nguyen Group and Syndicate 2047 kind of stands out because they're really ambitious, and it's not just a regulatory workaround for them, and they're trying to build a proper platform led by Bobby Sarup. And there's quite a lot of news coming from them, and we see days they've got the Lloyd's of London approval to write business from India. They got the Gift City approval, and then now there's the funding that they've raised from pretty solid private equity firm, JC Flowers. So it's quite an interesting development in that market.
Thanks, Mithun. Now on to the 1-4 renewals, with the first stop on our regional tour, India.
So India is, a fascinating corner of the global reinsurance market at the moment. The country is attracting a record influx of capacity from global reinsurers who, want to buy into India's structural growth. India's GDP is currently growing by around 67% a year at the moment, and it's one of the fastest growing economies in Asia Pacific last year. And this is creating rising demand for insurance products, particularly among India's rapidly expanding middle class. And that in turn is creating a need for reinsurance. At the same time as this period of economic expansion, India's government has also passed numerous major insurance reforms as part of its Insurance for All by 2047 agenda. This includes allowing 100% FDI for insurance companies and establishing and growing Gift City, India's special economic zone, which offers reinsurers special tax and capital benefits to establish their presence in India. There's also other big changes happening to the solvency regime and the accounting rules which are intended to align India with international standards. And ahead of the 1-4 renewals, I spoke to several, top Indian insurance brokers, including JB Boda and Ed May, Howden and Guy Carpenter, and we were told to expect significant rate reductions for property cat programs in India and intense competition. between reinsurers for business. And that's certainly proven to be the case. And according to Aon's 1/4 renewal report out today, Cat XL pricing in India was down 15 to 20% this time around, with abundant capacity. Casualty pricing wasn't down quite as much, but it was still down 5%. And, these figures do show that India's in the middle of a major market softening, fueled by this influx of capacity. And obviously, the insured natural catastrophe losses in India have also been relatively light as well. It was mainly dominated by flooding last year, rather than any major peak perils.
Thanks, Aidan. Yeah, I think every other story that we're reading and writing at the moment has an India or Gift City angle. So India is definitely an up and comer in that respect. But the 1/4 renewals are traditionally, the big focus is Japan. So I think we'll pivot to there next.
Thanks, Andrew. Yes, 1/4 renewals spread across most of Asia Pacific, but I think bulk of the books that renew in terms of value comes from Japan, and indeed focus of 1/4 renewals probably globally is on Japan, considering the scale of the market. And when we talk about treaty renewals, I think a large part of those renewals are for property catastrophe books, and Japan naturally is a big place for property catastrophe treaties because of earthquakes and typhoons that often impact the region. I think the news from Japan is very similar to what we've been hearing at 1/1 and similarly in India as well at 1/4. There's been significant rate reductions. I think Gallagher Re puts it between 15 and 17.5% reductions for loss-free accounts. I think Aon's suggesting that reductions about 15 to 18%, again, for cap-free accounts. The interesting thing about the Japanese market this time around is that across the board, it's been loss-free, especially on the property cat side. There have not been any significant catastrophes this year and almost nothing the year before either. So it's been a fantastic couple of years for the primary insurers from a cat loss experience perspective. And I think the reinsurers have come around to sort of rewarding the insurers for that experience. Obviously, we've been talking about the record capacity levels in all these markets, and it's not different in Japan. Japan obviously is one of the most important diversifiers for international reinsurance companies, and they continue to find it very attractive, especially as a diversifying market. I was speaking to Gallagher Re's George Sheriff earlier this week, and he had some really interesting insights. It's not just that there is additional capacity and a benign cat loss experience. I think that a couple of other dynamics that has played into these renewals. One primarily is that unlike some of the other markets, most of the other markets around the world, which had seen sort of primary rate softening in the last couple of years, certainly in the last 1 year, Japan's gone the other way, and we've seen continuous increases in rates. The insurers have been taking a very prudent view on underwriting, and they've been pricing their risks increasing their rates pretty substantially. In that background, I think reinsurers are quite happy with the performance of their portfolios, and as we've seen with some of the reports, there is quite a lot of interest for proportional treaties and pro rata treaties, and the recent Berkshire Hathaway Tokio Marine deal speaks to that sort of interest for proportional treaties from the market. Quite a lot of underwriting reform that has brought in good results for the insurers and reinsurers. The other factor is, of course, the fact that there isn't a lot of demand growth, primarily because of the demographics of Japan. There isn't a lot of new policies being issued considering the population decline. That's one aspect. The other aspect is that the inflationary environment in Japan is more modest compared to the rest of the world. So, there isn't a lot of inflationary growth. So the demand purchase from the Japanese insurers the demand for limits haven't really grown from Japanese insurers. That's primarily on the property cat side. The other side is the casualty renewals, which has also seen quite favorable buyer-friendly conditions, primarily because the Japanese casualty treaties have been affected by their exposures to U.S. casualty policies, which are, as we all know, have been severely impacted due to some nuclear verdicts in the past. What these insurers have done is to reduce their exposures to U.S. And I think, again, Gallagher Re's Sheriff was telling us that insurers have been successfully able to show reinsurers that they had tangibly reduced their exposures to the US, and reinsurers are quite happy with that, and they're happy to sort of reward these insurers. And the other thing is that per risk policies were something that as property per risk policies were traditionally harder sort of treaties to place in Japan because of the original rating conditions and terms and conditions. Sheriff mentioned that there's been significant re-underwriting on that sort of portfolios, which has meant the ratings and the terms and conditions have become very, very, very attractive to reinsurers. So those policies have also been very well placed. And finally, I think one standout theme from this renewals from Japan was that the growth in facultative. Again, I think earthquake FAC is quite common in Japan. But what's happening, as we mentioned with the per risk treaties, fire and risk FAC is becoming more attractive, as we've seen, because of the underwriting improvements and rating increases. So I think it's been an overall very attractive renewals for Japanese insurers. This is the second in a row where they've got double-digit reductions. But I mean, I think the final takeaway is, at least when I spoke to Sheriff, the question is, what does that mean for the primary market? With these two years of reduction, would that lead to rate reductions in Japan? I think Sheriff's view is that that's unlikely. The sort of shift that we've seen in Japan towards a bottom line focus and governance and good underwriting discipline will continue. So there will likely be incremental increases on primary rates, but also the fact is that there have been significant increases. So it's hard to tell how much increase would be there, but certainly there is no softening or rate reductions likely in the immediate future.
Thanks, Mithun, for those insights. Now, sticking with North Asia, 1-4 renewals also happening in South Korea. Roshan, what have you heard?
Yes, so South Korea's April renewals also reflected a more competitive environment this year, supported by ample capacity and a generally benign loss background. Gallery reports a sharply bifurcated market at April 1st. Pro rata commissions rose 3 to 5% for loss-free accounts, but fell 15 to 25% for loss-hit programs. Catastrophe layers saw 5 to 20% increases for clean risks, while loss-affected programs faced a 10 to 15% reduction. Capacity remains abundant, which also helps soften terms for clean accounts, while loss-affected programs saw higher pricing and deductible. In Aon's report, they said that cat excess loss pricing in South Korea fell 10 to 20%, and proportional commissions rose 1 to 2% as well. Demand remained strong, and placements were oversubscribed, with proportional treaties seeing improved terms. Casualty and specialty lines also saw reductions, supported by a benign loss year and limited catastrophe activity. We also got to know from HDI Global's Ki Hyun Jo, market lead for their South Korea representative office, that South Korea has experienced more frequent and severe large loss events in recent years, which has tightened the market. Excessive loss rates have increased, while quota share treaties saw stricter terms, including reduced commission and loss participation. Retentions have also risen since 2024, pushing more losses back to insurers.
And last but not least for this 1-4 roundup, the Philippines. Joana, what can you share with us?
So I spoke to local brokers and went through published reports by global brokers. And of course, the Philippines is also experiencing a soft market. So according to Gallery's first view report, Philippines, which also experienced a benign year for nat cat activity, saw loss-impacted property policies even having reduction up to 10%, with more reinsurers participating in 2026, showing a continued appetite for growth and interest in Asian markets. For catastrophe loss-free percentage change is about minus 15% to minus 18%. Risk loss-free percentage change is about minus 11 to 22%. Pricing targets were achieved despite lower attachment points, and market capacity remained ample, resulting in favorable outcomes for cedents. Notably, reinsurers showed willingness to include nat cat perils in proportional programs, something that they had resisted in prior years. The April renewal period also involved fewer clients than general one. However, the programs were generally bigger because of the soft market conditions in 1/1. Many clients is seeking improved terms and exploring alternative structures, to optimize their reinsurance. Many clients were also considering buy now option and additional layers of protection. There is evident interest in exploring parametric insurance. However, negotiations still ongoing. It remains early to assess the success of integrating parametric and traditional structures.
I mean, we saw with the Japanese market, there wasn't a lot of growth in limits purchased. What's been the experience in the Philippines, considering there's been a softening in the market? Are Filipino cedants buying more limits?
Yeah, so there's been a gradual trend of higher retentions among Philippine insurers, particularly for cat-exposed lines. So Raman Zanduta, Managing Director and CEO of broker KIM Re, told me that because cat reinsurance pricing increased in recent years, many insurers have chosen to retain more of the primary layers of risk while relying on reinsurance for higher layers. And William Pang, Group CEO of ARD, said that this is because clients' over motivation is to cut the reinsurance spend, and also they are buying smartly. For example, instead of buying all nat cat perils, some of them are choosing to purchase earthquake covers only at the top layers, since earthquake risk is driving the peril up that level.
And Joana, what about the Iran war? We've seen fuel shortages in the Philippines. We've seen national emergencies. We've seen people being asked to stay at home. Sure, there must have been some impact here, given the conflict in the Middle East.
Yes. So Zenuta from Re said that the tension in the Middle East may accelerate the transition towards renewable energy, because the country imports the majority of its oil and gas requirements. So that there's been a strong push in recent years to expand renewable energy capacity, and this transition is expected to drive continued investment in energy and infrastructure projects, which will in turn increase demand for insurance and reinsurance capacity, particularly for construction, operational risk, and cat protection. Moreover, William Pan from AIB also expects that the soft market will continue to persist through the 1/7 renewals, especially because reinsurers are still being able to achieve expected return on investment of their capital. However, achieving the same conditions for the 1/1 renewals in 2027 will depend on the duration of the war, as well as the nat cat loss experience in 2026. And if the conflict lasts longer, there's also a risk of stagflation or even recession in the worst case scenario, which will challenge the entire insurance and reinsurance industry.
Yeah, I think that's interesting. I mean, I think the Howden Re report from this week on the renewals as well mentioned the impact Middle East conflict could have. As of now, I think the dislocation is currently concentrated in the specialty lines like marine war risk, energy, and political violence. But Howden Re said that a sustained energy supply shock raises the risk of renewed inflationary pressure and higher interest rates dynamics that have historically affected reinsurance capital and pricing across all lines. So, in the coming renewals and into 2027, the conflict in the Middle East could have a telling impact.
Thanks, everyone. Yeah, that was a bit of a whirlwind tour around the region. I'm sure there's definitely going to be plenty we can pick up on and more things to pick at. But for now, we do have still some stories in the pipeline. Aidan, what are you working on at the moment?
So I recently sat down with Sheldon Yu, who is the CEO of Taiping Re, to discuss the Hong Kong-based reinsurer's plans for growth, including, its efforts to support the development of the economy in the Greater Bay Area and its involvement in the establishment of Hong Kong's local ILS market over the last 2 years. It was great to sit down with Sheldon in Taiping Re's offices, particularly as he's never sat for an English language video interview before, so that should be an interesting story to tell.
Thanks, Aidan. Yeah, one to look forward to there. And Joana, what's on your diary for the coming days?
So the General Insurance Association of Singapore published data about the domestic general insurance sector last week. One of the notable insights is that the property claims have increased by over 60%, mainly because of a rise in fire incidents across residential and commercial properties, as well as several large property-related losses. This led to, its underwriting profits decreased by 97.3% from $32.5 million to less than $1 million. So I'll be speaking to brokers as well as insurers to dig into this topic and find how these losses have impacted the market.
Thanks, everyone. That's a great meeting and certainly plenty to work on going forward. That's back to work, as Mithun would say.
You're about to listen to an interview that I had with Nigel Fitzgerald, co-founder of Australian MGA, Kaibridge. Nigel joined hands with former AIG CEO Graham Keynes to launch Australian MGA, which they are calling it AI First and Digitally Native MGA. Nigel lays out his plans for this whole new approach to underwriting in an otherwise crowded MGA market in Australia. Listen in. With me today is Nigel Fitzgerald, a seasoned insurance executive and the founder of Kaibridge MGA in Australia. Nigel, welcome to Between the Lines.
Thank you. Thanks for having me.
Nigel, you've had a long, distinguished career in insurance. You've been at AIG, Steadfast, and now you're launching a tech-driven MGA. What inspired you to take this entrepreneurial leap?
Well, thank you for referring to it as a distinguished career. I appreciate that. But in thinking about this, I've been flirting with it for quite a while. I did a startup in 2011 after 12 years with a corporate, and that involved 12 months of networking my way to the right execs, pitching my business plan, got traction, supported by a group called Fairfax Financial out of Canada. Wonderful entrepreneur, runs our business, Prem Watson. They backed me to do a business from scratch. I joined as an employee, and one of the most enjoyable moments of my career, if I'm honest, to be trusted to make decisions, to lead a startup from scratch, back your own vision of what the market needed and the type of culture you needed to build to, maximize that opportunity was wonderful. But I was effectively an employee, and a couple of years later, they just offered me a bigger job and a different challenge, and I jumped at it. But it was more of a turnaround orientated opportunity. So when I think back on it now, I really loved the startup more than I did the turnaround, even though the turnaround came with more notoriety and a bigger role. And then I had a second, bite at the cherry when I moved home to Australia in 2018 for personal family reasons. Fairfax were keen for me to do something then, and I spent months working on another business plan to launch a digitally enabled insurer or agency in Australia, and I was contemplating the turnaround CEO role at AIG in kind of parallel. And clearly I took the AIG CEO role, and I think back on it now and wonder if I chickened out or whether the idea just wasn't quite good enough. And I tend to believe it was the latter, because I definitely got a little bit more out of my late-stage corporate career at both AIG and Steadfast, particularly Steadfast. I really enjoyed working with Robert Kelly and learned a ton, but that final corporate experience convinced me of two things. One was that I wanted the remainder of my career to be at risk. I wanted to back myself. And I wanted it to be a challenge that I was passionate about, not just a job for argument's sake. And I think I've achieved that with both of these. I've achieved both of those goals with this challenge, and excited, looking forward to it.
This is effectively a third shot at it. And third time is the charm, as they say.
Are you suggesting I failed at the first two shots, or? But this time with my own capital, it definitely is a different experience, and so far I couldn't be happier.
Great. That brings us nicely to the foundation of Kaibridge itself. Grant Keynes has joined you to set up the new MGA. How did the idea for Kaibridge first take shape, and what sort of market gap are you looking to address with Kaibridge?
Yeah, I'm really lucky to work with Grant, an incredible executive with a wonderful track record in his own right. We were just industry friends, to be honest. We'd never worked together before, but we'd spent enough time together to develop a mutual respect. And I guess it started when I pitched an idea to him that I effectively had on a one-pager, pulled it out of the top pocket in one of our social catch-ups and said, what do you think about this? And, one thing led to another, but reflecting on it, I think it's almost the same challenge that I was always trying to solve. Was I just have forever seen so much inefficiency in how we serve our stakeholders. And in my mind, stakeholders are your customers, your team members, and your capital partners. And there's just so much opportunity to do that better. But we've all just suffered through the legacy of operational bureaucracy or technology debt and tried to make the most of it. And I think when I look back on that 18 almost startup, I think what I hesitated most at was I didn't know how you differentiated technology-wise. You're effectively going into core technology stacks, mainly with one vendor, locked into their ecosystem on development. And so really you were a smaller, almost as costly version as your bigger counterparts and sitting at a significant, I think, startup disadvantage. And I think now where the final confidence came was seeing two things: that technology's evolved to more of an open source environment. Today you can work with multiple suppliers and get the best of what's available. And, we don't have any plans to be a technology company and license our technology. We will use the best of what is out there in terms of vendor-led solutions. Some people have put some really good time into some of the tooling that's out there today. But what we will marry it with what we own is our own workflow solutions, which is where the AI native claim comes from, and our intent to develop automation and AI solutions, workflow solutions to complement that core technology stack. And with the two together, I now see a significant advantage to be legacy free. And, we're embarking on, I think, what's a more difficult journey than what we first thought, but still equally as exciting. There was just a lot more detail to achieve that goal than we probably recognised when we made the first bold decision to do it. But, I still stand by this is not an industrial revolution. It's even bigger. We're right at the front stages of, a whole new approach and a whole new way to do business, and we plan to take advantage of that.
I mean, you've spoken about, overcoming technology debt and operational complexities and legacy holding back some of the businesses. What does digital first and AI native business actually mean in practice? Could you share an example of how that approach is different and how you sort of implement that at Kaibridge?
I can. I'm hesitant to tell you too much because if I hadn't been free of my corporate responsibilities for the last 6 to 9 months, I wouldn't know what I know. And as I said, I naively jumped out thinking that I understood. But I'll put it under the banner of operational readiness. To get the consistency and accuracy out of the AI, it really comes back to how well prepared you were to apply it and how you effectively govern the reference source materials and the quality of the process mapping or decision-making trees that you apply to the way it operates from start to finish. And the bit that I referenced before was maybe underestimating the detailed level of work is exactly that. I think it'll take us at times twice as long to do the same activity as if we were, doing it as a normal startup. But by taking twice as long, we'll get an enterprise level advantage for the long term. And what I mean by that is if it would ultimately take 10 people in our organisation, at maturity, we'll still be 1 or 2. So we'll take the hard yards up front and take longer to reach maturity. But as I said, expecting a significant enterprise advantage at the end of the journey.
So you've just acquired Blend Insurance Solutions to sort of launch Kaibridge. It's primarily an A&H MGA. So how does Blend fit into that broader strategic roadmap that you have for Kaibridge?
One key part was who I'd refer to as our third co-founder. So Grant and I get a little bit of notoriety because we've done more publicly facing roles, but Chris Nguyen joins us as part of that acquisition, and I'd say and credit Chris for taking what is a collective thesis into practical application. So I'd like to think, relatively knowledgeable about how we do this. It's actually Chris that's bridged that gap between me drawing on whiteboards or Grant drawing on whiteboards and Chris going away and working out how we actually practically make that happen. So I describe Chris as a dyed-in-the-wool insurance technician that's crossed the bridge over into being technical and, happily codes away himself in AI and builds proof of concepts and things of that nature. So Chris was a key attribute in that acquisition, but then also a business that is meaningful enough without being too meaningful that we can redo everything. So the core technology stack and the workflow solutions, and effectively discard the old environment. And that readies us for expansion. We could, in an old model, we'd be expanding already. We have confidence that we have capacity relationships that would like to support us. We're confident that we have talent that would like to join us. But if we rush that to market, we'll be trying to retrofit that again down the line. And as I mentioned, we see that taking longer than we first envisaged. And so we have a serious commitment to building the plane before flying it. And so, that's busy. What we're doing now is retrofitting Blend into the new operating environment. And then once we've done that, it'll be well suited to expanding organically or via acquisition. We could then lend those capabilities to businesses that join the Kaibridge umbrella. Acquisitions are easier said than done, and a lot of people get starry eyes over the idea of growing through acquisition. We expect it to be a little bit like, looking for a needle in a haystack and trying to find that right fit. But we do believe we'll be well positioned as the real independent agency consolidator in Australia, if and when it makes sense. But yeah, the strategy is to grow Blend organically and position ourselves for the right inorganic opportunities if and when they present.
If I might just come back to you about, you said you're retrofitting Blend into the Kaibridge sort of framework. This is massively different. I mean, what does that mean actually in practice, really?
Have you heard of the phrase Twin City, which in effect means that you build the new environment while still living in the old environment, and your plan is to migrate out of the old environment into the new environment? That is as simply as I can explain it, and that is the reality of what's going on. So we're busily replicating what we and how we operate Blend today, but with how we plan to run it in the future. And that's why I said the size of it was important. It's not an overly big business. And so therefore we're not sacrificing a lot to exit its old environment at the end of completion of the new environment. And that works really well for us. And we'll effectively leave behind the old operating model, which isn't terrible, by the way. Chris did a great job building that, but it was in 2017, 2018, and a lot's changed in that period of time. But the thought process for which Chris approached that is still highly valid. We can just do it better.
In the new environment, the way you interact with intermediaries and your clients and how you underwrite, do claims, everything will be different and it'll be digitally enabled. Is that how it's different?
Correct. Yeah, I'll give you a couple of examples. So if we said before that we had 3 customers, our business will initially be broker focused. So for our brokers, we'll be API agnostic. We'll be able to ingest data from our brokers in whichever way they'd like to share it with us: email, file access, where many of our competitors are out there offering a portal. And that repetitive process for a broker to go to many portals to get options isn't ideal for their business model. They want to send the same information to as many people as possible to get an option in return. So we're able to design that from the get-go. And so when we approach somebody, we'll be able to say, however you like to share your information, we'll accept it. And that's a considerable difference to some others. Whether it's our capacity providers, we'll be able to offer integration and sharing of information, both risk data and risk and compliance information real time, which we wouldn't have been able to do in the old environment as nimbly as we will be in the new environment. And if it's an employee, we already have proof of concepts where we're taking underwriting processes that may have been hours long previously to now being less than a couple of minutes. So all 3 stakeholders win in that situation. So we're able to build core technology supported by workflow solutions that mean the broker customer wins, the capacity customer wins, and the team member or employee customer wins.
Obviously, the obvious question is that Australia, the MGA market in Australia has been going through quite a boom in recent years. We've seen quite a few new MGAs launch, and it's already been a fairly crowded market. I mean, certainly relative to the rest of Asia Pacific, we are in a soft market. So, what are the prospects for a new entrant, and how do you see Kaibridge sort of navigating this sort of environment?
Yeah, really good question. I expect most people externally would just assume we're a mistimed underwriting agency, launching now and trying to enter a soft market. And I don't blame them for that view. We've got around 300 underwriting agencies, we think, in Australia. So it's a heavily crowded marketplace. That's a very accurate observation. Soft market. I'd say it's a two-speed market. There's certain sectors and segments in Australia, particularly personal lines, that are probably not soft, but anything mid-market to corporate definitely showing signs of softness. It's the belief that our value proposition differentiates long-term, and it's for that reason that we believe that we'll be one of a few that can move to, as I said, addressing the three customer examples that I gave you, but also then, if you think about it, the cost to serve is cheaper, the capital management capability we have through profit optimization is greater. So even if we launch in a soft market and our turnaround times are within an hour, then how could a broker not show us the submission through worry that another broker will if they don't? So even if we're in a huge information gathering phase for the first year or two, working out how we use our improved business model to differentiate and when do we start to intentionally be more competitive than the market, then that's still a win. So it's with a long-term mindset, if I'm honest, but not a naive one. We've studied our competition and we're taking an educated position that they won't be able to move as fast as we can. And in some instances, I think some of the insurers won't be able to move at all to where we will be, and they will be somewhat forced to support us. They'll look to us as the way that they can compete when they are going to take far longer to do it themselves. So it's a patient mindset and it's a long-term mindset, but it's not a naive one. We've spent a lot of time confirming our points of difference, and we know that they genuinely differentiate over time.
And in terms of blends and A&H, MGA, and in terms of sort of product lines and business lines that you'd be writing, are there any focus areas for you? Are there specific lines that you like more than the others?
A lot of Australian general insurance commercial lines business is still done via email and phone. It's those areas that we want to focus on. We're almost product agnostic. Between Grant and I, there's not an insurance class that we haven't underwritten and overseen, so it'll be driven by opportunity in the first instance, but expect us to be a full service broker driven underwriting platform, and we're going to target the inefficiency. So where those brokers at the moment are waiting for weeks to get a return phone call or a response to their submission, we will head straight into those inefficient areas and work as they are working today, but just doing it far quicker and with far greater efficiency. So we look at our business model and go, it's an evolution, not a revolution. So I've seen lots of cool ideas, particularly in my prior lives where I was viewed as a possible corporate investor. And some of these ideas are great, but what they're banking on is a change of buying behavior or industry behavior. And I just think that that's going to take a long time. So what we're focused on, at least for the first phase of our business, is don't change the way it operates. Just do it far better than how the current incumbents are doing it, because of the difference you can create through starting legacy free and embracing both today's core technologies aligned to workflow solutions driven by AI and automation.
You intend to be a full service underwriter writing across lines, and I'm assuming some of this will be organic. You would try and build your own sort of teams over in the coming months, and some of it will be through acquisitions.
Absolutely. So from an organic growth point of view, we believe will be highly attractive to entrepreneurial talent to want to come and join us, just because of the capabilities that they can enjoy. And then we think will also be attractive to people looking for exits, particularly partial exits, like an entrepreneur that's spent a good amount of time building their business would like to sell 50% now because they believe that for the remaining 50%, by leveraging our capabilities, they can, grow the business, make it more efficient, higher profit margin, and that second exit is even more valuable to them at the end of their journey. So Yeah, I think organic and inorganic, we have a value proposition that'll be interesting to both, entrepreneurs looking to leverage our business model.
You have capacity agreements in place, or do you just
In
have
principle.
relationships that you think in principle? Okay.
No, in principle, we've already been around the world. Our goal
Yeah.
is to use capacity that's not significant in Australia currently in the agency space, and we've used our differentiating approach as the reason to why they would like to use us as either their first foray or their first large expansion opportunity in Australia. And whilst we've stopped short of contractually securing that capacity, I'm moving forward with extreme confidence that we have people that want to support our business model.
So we'll see some announcements from you in the coming months and later in 2026.
I think you'll see
fair
new product
expectation?
expansion in early 2027.
All right. Okay. As you said, it's a patient game.
I wish we could run faster, but it's just the reality. It's a longer process than I thought, and I sit here, smiling with you because I've learned a lot in the last 6 to 9 months. This is a harder challenge than it sounds. I think we're all thinking that we apply AI into our business. AI comes after you're operationally ready, and I think therein lies the challenge.
Great. I mean, Nigel, that's all the questions I have. It's been a fascinating conversation. Thank you very much.
No, thank you for your time. I've enjoyed talking to you.
Well, that's all from this episode of Between the Lines. We'll be back to our regular programming and we'll return in 2 weeks after the long Easter holiday. In the meantime, you can contact us on LinkedIn. Make sure you subscribe to our daily and weekly newsletters delivered straight to your inbox. And of course, we'd love to hear your feedback on the podcast. Email us at editorial@insuranceasianews.com. I'm Andrew Mullen. Thanks for listening.